Hello, class. This is group 5 here, and we picked Amazon and Walmart for our evaluation. So let's get started with what we found out. So let's explain our methodology really quick. What we wanted to do was first start with stating our reasons for selecting these companies, and then go into the operations management of those firms. See how they operate, what their strategies are, and whatnot. And then we went into calculation of cost of capital and then return, and analyzed the debt policies and the dividend policies. And then later on, we completed a evaluation, and then we're going to provide our recommendations. So, so first, why Walmart and Amazon? So first of all, it allowed us to compare and contrast, two of the biggest retail giants in the country, well, over the world pretty much. And then considering that they have a total equity of over $135 billion, it was, two companies that we wanted to select. And Amazon is a growth focused company, as you guys can see, and they have almost 60% of their shares held by institutional investors. And Walmart, on the other hand, is focusing on stable income because, as we will see later in the slides, they pay dividends, and investors who are looking for a stable income over the course of time prefer companies like that. And between the two companies, they're capturing almost 45% of total e-commerce sales. And then we were going to look at the corporate governance because these companies operate differently in terms of internal corporate governance. So let's first start off with operations management. So we're going to do a comparison between both Walmart and Amazon in 4 areas of operations management that we picked. First is in terms of competitive advantage. So you can see Amazon as main competitive advantages from their use of superior technology, like the website, the artificial intelligence and data mining that they use, and then the vendors who thousands and thousands of them who compete to sell on their platform. Walmart, on the other hand, is using the time tried method of low cost and lower selling prices. They're the rollback feature that pretty much everybody is familiar with if you ever step foot inside a Walmart. And then they created the whole Great Value brand, which focused on lowering production costs. And then the suppliers, as you guys know, they go to Walmart headquarters and then they bid and then they present to get an inch of space, shelf space in the store. So the competition is from suppliers so that they can place their product in a Walmart store. And then the second one is a location strategy. Now, Amazon obviously is going to be placing their distribution warehouses to reduce shipping time. That's their main concern because they're shipping everything everywhere and they want to make sure that your shipment is there in a day, two, or whatever the lowest time is. And then there's that the cost of capital is actually lower compared to Walmart because your distribution centers can be in the middle of nowhere as long as it's centrally located from a shipping perspective. And all they need are a few large distribution centers. Now, Walmart, on the other hand, has to have stores in every urban centers and population clusters, and thousands of stores are required, as you guys can see, because their goal is to reach the most number of customers, and they need to have that available. And then Walmart is going to be transitioning a lot more to e-commerce, the last few years and in the coming years. So this should help them a little bit on that location strategy. And the next item is a supply chain management. It's from a supply chain management perspective, Amazon customers are shielded from a lot of things that go in the background. They know they want a product, they purchase the product, and the product gets home or shipped to them. They don't. And on the case of Walmart, when you walk into that store, you expect to see that product because if that product is not in the shelf, you're not purchasing it unless you're going through the e-commerce route. But that's not where majority of their business is from. So the inventory must be on hand to make a sale for Walmart, whereas on Amazon, the inventory can be moved in the background. So that's a big advantage for Amazon. And then from a human capital strategy, soft skills, Walmart employees are directly interacting face to face with customers. So you want to make sure that their soft skills are way better than maybe an Amazon customer service person who's on the other end of a chat or a phone. they can just follow a few scripts that are laid out by their management team. They fix an issue, offer a refund, done. But Walmart customers are complaining about this and that and returning produce and fresh produce and all that stuff. So a lot more human capital is involved for Walmart, and Amazon has an advantage there because that the cost of human capital, let's say, is lower for them. So now we'll go to the next area, which was our first calculation, which was cost of capital for both firms. Now, these are all well laid out in our memo, so I'm not going to go through the details of the spreadsheet or our calculation, but from a summary perspective, we used the 10-year treasury to come up with the risk-free rate. And then we calculated like the beta for Walmart and Amazon. And as you guys expect, Walmart's beta is pretty low. It's 0.29. It is a very stable company, and it is not the volatility is very low compared to the market movement, and whereas Amazon's beta is higher than which a market movement, because it's you would expect a growth company to move the share prices to move a lot depending on which direction the market is moving. Now, we had calculated the cost of capital for Walmart to be about 4.24% and Amazon to be about 5%. And then we added about 2% to each one to come up with our hurdle rate in our calculations in the memos. And then we went into the return of capital for Amazon. So what we did was we used the last 5 years and then, came up with the range. So as you might expect, Amazon is showing very heavy growth trend, and the online retailers, in the same industry, are averaging like 9%, whereas in terms of return, whereas Amazon is returning 13 to 15%. And considering our hurdle rate was 7%, this is a large positive return, and it is our recommendations for anyone interested in investing in a heavy growth company is to go ahead, with Amazon during that time. And then when you consider Walmart, their returns have gone down a lot recently. It has ranged as high as 8% and low as 0.5%. So whereas similar industries are returning about 7%. So Walmart, the return on the capital for Walmart is pretty low. But they are growing. It is currently, if you are an investor seeking growth, it is, Walmart's leaving a lot left on the table for you. And then we'll take a look at our debt policy. So Amazon has a debt to equity ratio about 0.45%, where Walmart has a ratio about 0.86%. And from an Amazon perspective, it is actually a very low ratio. Like if you look at eBay is running at around 3%. And then from case of Walmart, that debt to equity ratio has been very steady for over a decade. And both companies have excellent credit rating. Both Walmart and Amazon have been using debt to make a lot of purchases recently, which is good because they're both under leveraged. Amazon issued about $16 billion in debt to purchase Whole Foods, and Amazon used actually a pretty large number in 2019 to purchase the Flipkart, which is kind of like an Amazon competitor in India. So both companies are actually well positioned to take on additional debt and to improve their growth or make an acquisition, if that opportunity presented. And then we'll take a quick look at the dividend policy. You guys might know Amazon has never paid out dividend. They have always put all that money back into the company, and investors are relying on equity growth to make money out of Amazon. Now, this might be less appealing to income investors. I'm talking about people who rely on a steady income, like pension funds. Pension funds everybody's at the retirement age, or the requirement is that it's providing stable income during retirement age. So those investors like to go with companies that pay dividend instead of just going with the company that you're completely relying on growth. And Walmart, on the other hand, has been paying dividends since 1974. They've paid 47 consecutive quarterly dividend for 47 consecutive years. So that's great for people who are looking for stable income. And the annual distribution has actually always grown up for Walmart. It's kind of reached a stable level recently. They've been giving out the same amount of dividend for quite a while, but they have been paying dividends every quarter, and they pay every quarter, not annually. So, taking all this together, we're going to go right into the firm valuation for Amazon. We used all the calculations. So, since Amazon does not pay dividends, we couldn't use the dividend model. So, we went with the discounted free cash flow model for our valuation. And this is also laid out in our memo with the explanation. We expect Amazon to grow at 36% a year for the next 5 years, and then free cash flow was calculated to be about 3.7% of the revenue. Well, running all the numbers, what we found out is we estimated Amazon's share price to be about $3,072. It's currently at 3,300 and some dollars, changing a lot every day in today's up and down market. So the company is overvalued quite a bit. But the recent market, up and downs have been so inconsistent. It's really hard to come up with a very good number. And then in terms of Walmart, we're expecting a 6.4% a year rate for the next 5 years. And Walmart has a lot of cash on hand. They have about $55 billion in cash, and they're spending a lot of it recently, growing the online e-commerce and whatnot. But running the numbers for Walmart, we found out our estimation for their share price should be $123, and currently it's at $144. So Walmart is also slightly overvalued. Again, the market is just out of control, so these numbers are slightly hard to kind of pinpoint if it is good or bad, but in general it is overvalued. So what did we learn? There were quite a number of things that we learned. I mean, first of all, the goal is to find a firm. You as an investor want to find a firm that is going to increase shareholder wealth. So when a firm takes on a project, they have to consider all investment opportunities that they have, and the cash flow from all those opportunities. So Walmart pays a quarterly dividend, but their growth rate is pretty low these days, around 2%. Amazon return on capital is over 15%, while Walmart's less than 1%. And in terms of stock prices, Walmart's stock price has been, it hasn't, it's not like Amazon's. Amazon's stock has been growing exponentially. It has gone a lot in the last 10 years, over 35% return per year. So, like I had said before, our evaluation is Walmart is good for stable income seeking investors, and especially those who are closer to retirement age. And then Amazon's recommended choice for high growth seeking investors, the investors who are willing to take a slightly larger risk. Amazon is definitely the choice for that. So that concludes our presentation and what we learned. If you guys have any questions, please ask in the message board, and we'll be happy to answer. Well, thank you.